Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Leighton Kling. Coming up on today's show, we'll talk about a new study from First Insight about price elasticity. We'll also talk about Costco's most recent earnings call, and we'll wrap up the news portion of the show with a bit of a follow-up regarding holiday sales projections. A reminder that you can like us, rate us wherever you do access us, whether that be on Apple Podcasts, iTunes, any other podcast listening service, including Spotify. Those ratings really do help. And then you can also check us out on Twitter and Instagram at Retail Podcast. So we begin with that study from First Insight that suggests that elasticity and price sensitivity are actually falling across 4 different consumer categories. In this case, their study suggests that retailers could or maybe should be charging more for products in these categories, and that some retailers could actually be leaving money on the table as consumers may be willing to spend more. Some of the key reasons First Insight cites for elasticity dropping include the maturation of millennials in the labor market, thus earning higher salaries, elevated consumer confidence, and an increase in disposable income across the board. But Leighton, as always, we start with study specifics.
The study used data produced by Insight Suite, an analytics platform held by First Insight, and looked at trends across 4 different categories. 3 of the categories are apparel related: women's, men's, and children's, while the 4th is actually home goods. The decrease in elasticity is compared to their earlier study conducted in 2017. According to the company, hundreds of thousands of items were included to aggregate this data. This suggests a pretty decent sample size overall. We should take a moment to address the concept behind elasticity of demand, which some of our listeners may be aware of, but others just may not be that familiar. It's actually a fairly straightforward concept, but just a fancy economics term, essentially. It's demand for some goods that fluctuates greater than demand for others based on price. So basically, for example, if the price of milk goes up, it typically doesn't have a massive impact on the volume of milk moved by a retailer, as long as that price increase doesn't happen on an isolated basis. Same with gas, etc. And these types of goods are known as inelastic, which is to say the elasticity is lower. That said, some goods are highly elastic, which produces a high variability of demand based on price. Baby carrots, interestingly enough, are said to fall into this category because people will purchase regular carrots if the price of baby carrots are too high. So that's just one example out there. But when this study says that elasticity of goods is falling, this basically means that retailers can increase prices on the goods without a notable decline in demand, meaning that if retailers are not increasing prices just up to the tipping point, they might be leaving money behind. So in theory, there are a lot of items out there, luxury goods, that would probably, Trent, be considered maybe having a higher elasticity. Lower elasticity items would be things that you would need on a consumable basis, things that you need to live, to survive. But back to this particular study, generally speaking, First Insight found elasticity to have decreased not only among the 4 categories that I just listed as a whole, but also across most product groups in general. So looking at these study findings, Trent, we can start with women's apparel, where First Insight found elastic decline across the board. They see that retailers are appropriately increasing prices for handbags, swimwear, footwear, and jewelry. That is, prices are increasing in line with demand. However, the study does see runway for price growth in the categories of sleepwear, outerwear, bottoms, tops, lingerie, and dresses. In particular, they say that potentials for price increases here stem from growing spending power of millennials. And you do see wages increasing, as we'll talk about a little bit in our last story. But next up is men's apparel, where prices are increasing in one category beyond what demand will actually support. That category is tops, as prices have been rising, but the report shows consumers to be more price sensitive in this particular area. However, the price sensitivity ends there, as prices have been increasing in lockstep pretty much with falling elasticity in footwear, bottoms, and underwear. Additionally, prices have actually been falling in outerwear and accessories, And while the study doesn't see the runway to increase prices in men's as in women's, this is where First Insight sees opportunity for some retailers.
So again, outerwear and accessories for men. And as far as children's wear, the study's headline regarding children's wear is that it's generally well managed, meaning prices are relatively well placed in this category with a few exceptions. Granted, this category has seen some upheaval over the past year or so, with high-profile bankruptcies at players like Toys R Us and Gymboree affecting the marketplace. That being said, First Insight postulates that the reason we're seeing generally decreasing price elasticity for children's wear is because people are waiting longer to have children. Therefore, the price point at which they purchase children's clothes matters less because of parents' relative maturity in the workforce, again meaning they're earning higher wages when they finally do have children. As with men's tops, children's footwear is actually seeing a significant rise in price elasticity, meaning essentially that as prices of the children's footwear products go up, people are less likely to purchase them. This makes some logical sense since children outgrow footwear just like everything else pretty quickly. But footwear, when you compare it to tops or bottoms, often reflects a higher general price point than bottoms or tops. So we're seeing people more hesitant to spend big money on children's footwear versus maybe bottoms or tops there. Unlike with men's tops, however, retailers have been decreasing prices in kids' footwear, this coming in lockstep with that elasticity. So again, going back to the well-managed theme of the category, likewise, they have been increasing prices along to fit elasticity decreasing in children's dresses, sleepwear, and bottoms. However, the study does mention a major area of opportunity in children's tops, where retailers are actually decreasing pricing while elasticity is falling, meaning either there's a potential cash being left on the table for children's tops, maybe retailers should be charging more for those, or that children's tops are getting dangerously close to being commoditized. And you see this again with a lot of areas within retail that you have where you need to use things on the regular. Leighton mentioned, for example, milk or gas, that type of thing. Well, with children's tops, you know the child's going to outgrow those tops. You know maybe you don't want to spend a lot of money on that, but a lot of general merchandise retailers, Target, Walmart among them, but even the likes of Dollar General, are rolling out some of those children's tops lines, attempting to basically provide a proposition on price. And while we see people willing to spend a little bit more on children's tops, we really kind of wonder if there's just kind of a generic leveling out of the market when it comes to that you might be seeing here over the last couple of years, especially since a lot of those differentiated brands, we talk about Gymboree as being one, are started to kind of exit the marketplace. Now, as far as home goods is concerned, this is honestly the area of the study when we came across it earlier this week that we were most interested in. We've talked regularly on the podcast over the last couple of episodes about the home goods space, notably with Kirkland's and Pier 1. Pier 1 attempting to reinvent themselves, if you will, into a lower price point. However, this study suggests that while it may drive traffic in terms of lowering those prices, Pier 1 may just be hampering margins on their merchandise sales. To quote the survey, elasticity has fallen significantly across every home goods category with one exception, that lone exception being housewares. Housewares are seeing decreased price points, though, in line with the elasticity increase, so not really an area of opportunity or need of adjustment there, according to this study. But the study does find retailers to be maneuvering prices incorrectly in decor and textiles. As it pertains to furniture, they're finding maneuvering of prices going up along with that elasticity decreasing. But in decor and textiles, elasticity is dropping, but prices are also dropping. And again, you can equate this to basically leaving margins on the table, but also at the same time, there are just so many now off-price players in this space. We're seeing off-price stores really build out their portfolio in terms of number of stores throughout the United States, so people have more choices there, which forces the full-line retailers like the likes of Kirkland's, like the likes of Pier 1, to try to drop prices in that regard. But this study is actually saying, hey, there's actually some room there to increase prices just a little bit. And we're not talking increased prices in the line with what you might see at Restoration Hardware, which is in a premium area of that segment, but at least increase prices because people are willing to spend more in terms of decor, in terms of textiles. And this only doesn't go along with, the likes of Kirkland's or Pier 1, but we also see some of these categories leak into other retailers, Hobby Lobby, Michael's, that type of thing. Again, maybe suggesting that people are willing to spend a little bit more in this category, and yet we've seen a lot of hair pulling among this retail segment about tariffs. It all goes kind of back to that tariffs option there, and that's something this study actually goes forward and says is that, hey, retailers, especially in the home goods category, that are concerned about raising prices regarding tariffs, maybe they shouldn't be so concerned, because what they're seeing, at least through the First Insight survey, is that people are willing to spend more at its root.
Moving on to our second story, Costco released their quarterly earnings with more of the same in terms of sales and earnings growth, but we saw some headlines out there with major news outlets saying they missed analyst expectations. They did miss on comp sales, but earnings still beat expectations by a good margin. The initial shock regarding comp sales took the share price down in after-hours trading on Thursday, but it quickly rebounded and finished up on Friday, although, to be fair, most of the market did finish up on Friday. Looking at the particulars here, none of the numbers come as a very large surprise to us or a lot of people out there, since Costco releases sales numbers each month. And so that said, their adjusted comp store sales for the U.S. were up 5.2% over last year's fourth quarter. The United States has been performing very well for them for a very long period of time, although they are getting more and more exposure to international markets. This was adjusted for gasoline sales, was this United States number, exchange rates, and an accounting change. This was just below most analysts' expectations. The same-store sales figure was of an increase of around 5.3%, so they missed by about 0.1% there on that particular figure. However, e-commerce sales still took a bit of a jump, around 21.9% year over year. Shopping frequency, or traffic, increased 3.6% in the United States, while ticket size also saw a modest increase, 1.4% adjusted, fueling same-store sales. And if you look, Trent, this is actually slightly below inflation, this ticket size, but a lot more people are still coming into Costco stores, and they are, by the way, still expanding throughout the United States, and we'll get into that in just a little bit. But overall net sales came in at $46.45 billion, up 7% year over year, driven by those comp sales that I just mentioned, but also, of course, new stores. And revenue, including membership fees, came in around $47.5 billion. So if you look at that differentiator there, that is the membership fee. So the $47.5 billion minus the $46.45 that was reported, this beat versus analyst expectations versus the $47.1 billion that was slated to come in. Some news outlets erroneously reported that Costco missed estimates on revenue. Such outlets did not include the aforementioned membership fees in their reports. And of course, those fees are a decent portion of the revenue each year. If you look just on a percentage basis, they bring in a ton of membership sales. In addition to those comp figures, Costco saw more modest store count growth in the quarter, with 8 new stores in the United States and 1 each in China and the UK. We'll talk about China here in a moment, as that has been all over the headlines as of late. Adjusted earnings per share, meanwhile, crushed expectations, coming in at $2.69 per share against expectations of $2.54 per share. And we say crushed because Costco is one of the more transparent retailers. Let's be honest here. They're extremely transparent with the financial media outlets, with analysts. So for analysts to miss by this amount is actually fairly substantial. It's very noteworthy here. The adjustment to earnings per share was actually related to a product tax assessment, and that came into around 22 cents per share. Overall, a very, very healthy bottom line for Costco. And if you look, Trent, they actually do break out some of the gross margin increases that they saw in different product categories. And again, we talk about transparency with Costco. This is very nice. The CFO on the call went into a little bit of detail as to what they're seeing the greatest margin growth in and what is maybe a little bit stagnant or needs what we call opportunity. So if you look here, the fresh and soft lines categories actually saw the biggest increases year over year in gross margins, while hard lines saw maybe some declines. general grocery margins remained flat, but we all know that sales there are very, very healthy, and that's a hyper competitive arena. So to see margins remaining flat is pretty much more or less to be expected. So, and with that, Trent, we go on to the call details with all of the news surrounding the numbers. A number of news outlets trumpeted Costco's China penetration and their plans to open yet another Chinese location in the coming years.
Now, most of us did see the videos of Costco opening their first China location. Traffic was shut down around the store, and people swarmed that particular location on opening day in August. But according to the company, there's more where that came from, which we kind of knew. A second location in Shanghai is slated to open up in early 2021. Now, leadership said on the call that their first China store already has 200,000 members. Their other stores average around 68,000 memberships per store, so already about 3 times the number of memberships in this store than they average throughout the world elsewhere. Another talk of analysts after the call was the prospect of another special dividend for Costco. Now, they haven't released one since the spring of 2017. Usually they do so every 2 or 3 years, and Bank of America and Stifel analysts both feel that one is around the corner, and that's something that's constantly rumored about with Costco associates and employees. Now, as far as other noteworthy details on the call, they spent a lot of the call talking about digital, and again, we don't want to beat a dead horse because it seems like we bring this up every time when we talk about Costco, but just a couple of years ago, you would be on a Costco call and they didn't talk much about digital. There was a lot of discussion surrounding e-commerce this time around, just like we've seen over the past couple of calls. E-commerce for the first time this past quarter, according to management, carried some new items, bigger ticket items like KitchenAid appliances, Weber grills, and also they mentioned a few high-quality beauty brands as well. And they basically said, hey, we're trying to align that e-commerce stance that we take with the physical show location. So they talked a little bit on the call about what they call merchandise roadshows, kind of a treasure hunt, if you will, for the Costco warehouses. Leighton has talked about purchasing products through these roadshows in the past, kind of specials or one-off deals. Well, they mentioned they're really excited because some of that type of presence is now happening online. So what they're trying to do is bring that treasure hunt mentality that they've got in stores with some of those merchandise roadshows to the online platform. But they also spent a lot of time talking about the app. And in terms of their app, they're just trying to keep up with the Joneses or really catch up in terms of e-commerce because their e-commerce site was so far behind. But they're really excited about a few new additions to the app, including using the app as a digital membership card. That was just added in July, to which Leighton and I both say it's about time. It's kind of weird that these warehouse merchandisers or warehouse retailers force you to have that physical card. That's no longer the case, as if you download the Costco app, you can currently add your membership card to that app basically and show it as you walk into the store. Over 2.5 million activations of this optionality during this past quarter. Also, the app, of course, allows you to re-up on the digital memberships or sign up for the digital memberships as well. Now, the other things that they're excited about surrounding the app, you can actually view current gas prices at your local Costco warehouse. And also executive members can, of course, kind of monitor their progress regarding the 2% executive member reward. That executive membership comes at a little bit of a higher cost than their most basic memberships. But again, we recall that 2% member reward that they get in terms of the cash back there. Also, a few things related to pharmacy as far as being able to refill prescriptions and managing prescriptions. And they also have other enhancements in the works, something like shopping lists and also future promotional offerings. So a lot to digest on this call. It wasn't just all about the great same-store sales we always talk about surrounding Costco. Wasn't all about China on the call. Lots of digital initiatives above and beyond their website, which I think is a great sign for Costco. It would be great if they could get some of that app build out completed by the fourth quarter when they start to bring in some of the new customer base as they begin with some of those Black Friday sales and the promotional activity there. So a lot to look for here as far as Costco going into what is their fiscal first quarter or the final quarter of this year based on the calendar. Now, they did talk briefly about tariffs, but again, they don't know really where things are going to go as far as tariffs. They said, hey, it's going to be a wait-and-see approach as far as how those impact our bottom line. Well, we kick off the second half of our podcast with somewhat of a recurring segment where each Leighton and I talk about a retailer that we've visited over the last week and kind of our experiences with that retailer. This week, we'll start with Leighton. And Leighton, as I understand it, you're looking to talk about a retailer we literally just discussed here on the podcast.
Yeah, and I'll keep it short because of that. A lot of people don't want to hear about Costco for 45 minutes, but I did visit my local Costco, and it's interesting, Trent, because they're in a larger market, it ends up being more of a test store for a number of piloting initiatives that they have going on with inside the company. So for instance, they now have created an area where you can self-scan or self-checkout. So you can go through the lanes similar as you would to, let's say, a Walmart or a Sam's Club that has self-checkout, scan your items, and you're good to go. It's interesting because they have a few loss protection initiatives that are built into the system. You can tell right away they have two associates that are kind of looking over everybody to make sure not only everything's going smoothly, but to make sure that all of the customers that are using the new self-checkout lanes are actually scanning all of the items that are present in their individual baskets. The other thing that I noticed, and it's really smart, it's fairly logical, but not a lot of retailers thought about this when self-checkout was first becoming a thing. Mark the receipts a different color. So, for instance, with my Costco transaction, I went through self-checkout. The receipt color was green. This indicates to the exit door greeter to check your receipt or to even double check your receipt because they're looking at receipts anyway, just to make sure that you were able to scan everything and that everything, again, went as expected or as planned on Costco's behalf. So that's a fairly interesting initiative. The other thing that I noticed when I went inside my local Costco is that more and more are they moving items around. They've always been known as more of a treasure hunt experience, but this in particular strikes me as a little bit frustrating because in the grocery aisles, they're moving a lot of seasonal merchandise, but also a lot of merchandise that is a Costco staple to areas such as end caps and pods, where they take it off the entire aisle where it's been placed for months or decades, and then they put it in an area where seasonal goods or one-time buys are most prevalent. So this was a little bit frustrating. A bag of tortilla chips took me about 30 minutes to find throughout the store. So we talk about treasure hunt experience and how that's usually, a positive thing for Costco. It gives positive imagery. Well, in this particular case, it's not. It's not a good thing for customers to just meander around the store frustrated, because if I'm just wanting to go in and go out and try to get my groceries in the fastest way possible at my local Costco, the last thing I want to do is be stuck trying to find one or two particular items that they keep moving around because they want customers to buy more. I think that's sort of illogical if we're talking about customer experience. But beyond that, Trent, that is my story for my local Costco. It's interesting to know that it is a test store, again, for a number of different things. A local associate ended up telling me that. They also told me that this store in Southern California does over $300 million in gross revenue. So they're doing something right, even though I sometimes am getting frustrated because they move stuff around so frequently. But beyond that, a good experience, and it's good to see that they're now testing self-checkout, something that, by the way, Sam's Club has had in various markets for over 5 years now. Well, for our last news portion of the show, we wrap up with a story that is really following up regarding holiday sales projections that we noted a couple weeks ago, and a departure from the past few years where NRF's projections are typically more bullish than most. The National Retail Federation released their expectations for this holiday season, and the results are showing that projected growth actually comes in behind other research firms that we noted a few weeks ago amongst macroeconomic questions. Those macroeconomic questions are becoming more and more prevalent, as you can see from the various major news outlets talking about political woes and then geopolitical woes. That said, retailers would still be quite pleased with the sales growth, even if NRF's projected range comes true. Those projections, by the way, see baseline sales increases in retail expected to be around 3.8 to 4.2%. The NRF does mention up front that it is tempered somewhat by a large number of factors, some of which I just mentioned, although their release does not mention the shorter shopping season, that is, the fewest days between Thanksgiving and Christmas than usual. And this is interesting, Trent, 6 days fewer than last year. You have to wonder why. Well, if you look at the calendar, Thanksgiving is actually at the very end of November. If you look at the calendar, which I am doing right this second, you see that Thanksgiving actually falls on November 28th, and then there's just 2 more days left in November before December starts. And we remember back last year, the holiday season seemed to really last forever, but then again, you did see a lot of woes there as sales ended up tapering off towards the last 2 weeks of December. The NRF notes that this is just above the average increase of 3.7%. So we're talking about the expected forecast here over the previous 5 years. And so the NRF's final numbers for last year came in a bit behind some estimates for actual sales at 2.1% growth, well behind their own expectations. That said, this was caused by, in large part, some concerns over market downturn and government closure. We all remember that, which was noted by most sources as slowing retail sales last December, which I just noted. In this case, they are projecting 2019 to come in behind 2017's increase of 5.2% growth, but ahead of increases in 2015, 2016, and 2018. Probably the most important year as far as a backstop or baseline for relative comparison.
Jack Kleinhans, the chief economist of the NRF and a former guest on the Retail Focus podcast, said that although predictions are made especially difficult this year with the number of political factors and the slight economic unease, the bottom line is that the U.S. has seen job growth and higher wages. Although the NRF's overall projections for increase this year are lower than Deloitte and Company, they're expecting roughly the same increase in non-store or digital sales than those other predictors. This year, they expect non-store sales to increase between 11 and 14%. Non-store, just a fancy way of basically lumping in digital with other sales, like the small amount of mail order sales that still take place. This is also in line with what we've seen in aggregate from retailers this year. Just looking at some retailers, you look at Costco, around 28%. Some are on the lower end of that spectrum or even worse than that. So 11 and 14%, a very respectable set for increase there. And as far as potential negative impacts that might offset higher household income, the NRF specifically noted tariffs. Going back to their survey in September, 79% of American consumers were concerned that tariffs would cause increases in prices and might affect their shopping habits, but larger retailers have been able to stockpile inventory or work with suppliers to keep tariff impacts down, maybe go elsewhere for sourcing goods and materials. That said, the NRF said that a number of smaller retailers or mom-and-pop retailers are already bearing the brunt of tariff increases, particularly surrounding the tranche that took effect on September 1st, including high-dollar items like televisions and other products like apparel and footwear. Finally, as far as the NRF's projections are concerned, they always include overall holiday hiring in their forecasts, and so they did that again this year. They expect 530 to 590,000 temporary workers to be hired for the holidays. This is a massive spread, basically, in expectations as you're looking at over a 10% spread between the lowest number and the highest number there. If you're looking at a comparison to 2018, 554,000 were temporarily hired in 2018. Of course, some of those turn into permanent jobs. This echoes what we've seen so far with holiday hiring releases. We expected it to be right around the same number as what it was last year. Some companies, like Target, are increasing holiday hiring. Some, when you dig deep, are keeping it around the same as what they are last year or what they were last year. And some, like the Gap, are actually decreasing hiring for 2019 versus 2018. The number of seasonal workers hired may also depend on the numbers available and willing to work. Also, As Leighton pointed out to me before we started the show, unemployment, of course, near 3.5%. And really, this is actually something that you go back, you do just a basic Google search, and you'll see people writing about this phenomenon actually in 2017, but it's become increasingly harder for retailers to bring in temporary work. That's why a lot of them aren't just bringing them on as temporary workers, they're bringing them on as full-time workers with benefits and the like to try and entice those seasonal workers in. And at this point, you're really looking at people that might not even be in the labor force, might not be in that 3.5%, just trying to entice them to rejoin the labor force, if only for a couple of months. Now, as far as other projections are concerned, Leighton Salesforce also released some projections, and as we alluded to last week in terms of the calendar impacts, they expect holiday shopping to creep forward on the calendar.
We believe the impacts from the shorter shopping season are somewhat overstated, and Salesforce seems to concur. In fact, Salesforce sees a potential 19% year-over-year growth in global digital retail revenue during the Tuesday and Wednesday before Thanksgiving, outpacing the expected digital sales growth during the rest of the holiday season. Salesforce's expectations for digital revenue growth come in at 13% year-over-year, in line with most other predictors' expected growth. Additionally, Salesforce has predictions about retailers using buy online, pickup in store, or click and collect options, and they see a 28% boost in revenue share over non-buy online, pickup in store rivals in the 5 days leading up to Christmas. As a result, Rob Garf, the VP of Industry Strategy and Insights at Salesforce Retail, says that features like real-time inventory tracking and quick in-store fulfillment will be crucial to allow retailers to differentiate during this time, and we seem to agree. Typically, you see a lot of retailers trying to advocate for these kinds of things or making their buy online, pick up in store systems work a little bit more seamlessly just before the holiday season. Finally, they predict that 52% of digital orders will take place through mobile, a stark increase over the previous years. We are starting to see mobile, really the knowledge gap, close as more older adults become comfortable with using their phones and other devices to shop and handle their finances, their personal finances and purchases in the retail environment. By the way, these numbers are generated through looking at different data points, shopping data from 500 million global shoppers, proprietary study of e-commerce sites, and a study of 10,000 consumers and their behaviors. So a major predictor they have is that most retailers will make a conscious effort to stretch the holiday shopping season rather than having it come organically through consumer demand. They say to expect retailers really hitting promotions for in-store and online hard in the week leading up to Thanksgiving. Something we saw, of course, last year, but this year it will be very interesting because the overall holiday shopping season is going to be a little bit smaller. Curious to see the promotional strategy and, moreover, the promotional spend of a lot of major retailers coming in the next few weeks.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
We've reached the final segment of the Retail Focus podcast, a segment we call Looking Ahead, where each Leighton and I will talk about a story we're keeping an eye on for the next week, month, or year. I'll go first here, and I'm really looking at a story that I'm kind of wondering if this might not set a precedent for retailers in the future. The story I'm looking at is a story that came out of Memphis or the Memphis metro area this last week. It came out of Retail Wire, but Kroger had recently closed a store in South Memphis, Tennessee. This actually harkens back to a conversation we had on the podcast all the way back in 2016, where Leighton and I talked about how retailers, particularly grocery retailers, bridge the gap between their fiduciary responsibility to shareholders to make sure that only the most effective and profitable stores stay open to their corporate and social responsibility there as far as keeping stores open in what would otherwise be food deserts. Well, Kroger actually found a way to kind of bridge that gap this fall. So they closed this store in February, again, south of Memphis, and they began working with groups to try and find a buyer for the space. Now, of course, the Kroger store didn't work out there, but they knew that by closing, they were going to create a food desert. So it said that the chain reached out to 30 businesses, could not find one that could afford the $500,000 building, according to Newsweek. To put this in perspective, in terms of retail real estate, a grocery store, anywhere in the neighborhood of 30 to 40,000 square feet or larger, should honestly command more than $500,000 in a market. So they were already trying to sell off at a fairly low price point, as usually you see those type of stores, even when vacant, they asked for more than $1 million on the open market. But in late September, what actually happened is, because it couldn't find a buyer, Kroger donated the building to a competitor. It's a small regional chain called Super Low Foods. They only have 8 stores there. And basically, Super Low found it pertinent then at that point to move in without paying rent or anything like that, owning the business to actually move in and create a grocery store there. Now, we often talk about the small margins associated with grocery, so not paying rent gives you that extra opportunity. In terms of margins, we've heard about a lot of grocers closing because of one reason or another, either declining sales, either because shrink was eating up their margins, that type of thing. So this is a major gap there that Super Low Foods in this location does not have to worry about. So ultimately, this is a way that Kroger has kind of found to make sure that there isn't a food desert there. And I like the quote from Rich Kaiser, who's actually quoted in this Retail Wire article. He's a consumer anthropologist at Kaiser and Bender Speaking, and he says, and I quote, "Sometimes there's more to think about than just instant deliveries, robots, and AI." And we couldn't find that any more true as you hear all of these retail news outlets talking about, well, what are we going to do to move to online sales? Click and collect, that type of thing. We hear so much about AI, so much about blockchain. Really, ultimately, it comes down to, again, those brick and mortar stores, the neighborhoods that are served, especially in grocery, by these brick and mortar stores. Sometimes you have to look at the social responsibility aspect of it. Kroger found a way to do this. Now, of course, they'll probably end up writing off the $500,000 building, but they found a way to do this without staying open, without hemorrhaging money at this location, and by facilitating a dialogue within the community about a new grocer. So I think this is not only a good PR move by Kroger, but it's also one that you might see some closing grocers in the future at financially stable companies pursue.
My story is going to lead with a little more pessimism, as the Retail Dive, a prominent online resource for us. And really, it's been a fantastic resource as far as finding articles, talking about relevant retail articles in the news out there, at least as far as U.S. retail is concerned. They put out a deep dive into what they called the 28 retailers that could go bankrupt in the next year. And this is interesting, Trent, because for as much as we cover retail and as much as we love retail, there have been a few notable bankruptcies this year, and there certainly were a number of bankruptcies last year. We were thinking this is maybe sort of the end of it. So they put out this list of 28 different retailers, and going through the list is very interesting because I can see how some of these retailers are definitely going to fall on hard times in the next 12 months or longer, but I think that some of these retailers are going to be staying around. I'll go through some of the retailers, not all of the retailers that they put on this particular list. Ascena, we all know what's going on there, so yes, maybe. A lot of apparel retailers here, and Ascena really leads the list in terms of retailers that we could see be extinguished from having any retail presence whatsoever in North America. A lot of apparel retailers right now are facing sort of an impossible challenge to become fully omni-channel, yet try to maintain a certain presence among the fashion industry and remain relevant in terms of the social media circles. Christopher & Banks was another retailer listed on this list. Destination Maternity, which I found very interesting. A lot of maternity sales are actually turning to online outlets. Again, a fascinating dynamic playing out there. J. Crew, Neiman Marcus. And I thought this was interesting. This is definitely not a retailer that I could foresee going bankrupt in the next couple of years. This is a retailer that, while yes, maybe their footprint is too big in some locations, and they are sort of a niche retailer that thrives on holiday seasons and other moments of seasonality, this is a retailer that I think is going to be around for a while. JCPenney, and sadly, I am still an owner in JCPenney stock and have been for quite some time. If you've been a longtime listener, you know that I've probably been in a JCPenney position for about 3 years now. this retailer, looking over their latest earnings report, okay, it could be doing a lot better. It could definitely be doing a lot better. Do I think they're going to file bankruptcy in the next 12 months? It is certainly possible. They have $3.9 billion, Trent, in long-term debt they still have to pay off. Some of it, by the way, is coming due in the next few quarters. So I think JCPenney has a hard time to try to gain ground in terms of customers coming into their stores. And one thing that I didn't like to see over their last earnings report, JCPenney, overall, their same-store sales, they've been declining and declining rapidly. And this is something that I did not want to see because they've already closed close to 100 locations in the last 2 years. Those locations were, in a very transparent way, the most underperforming stores for their entire U.S. division. So I think that having closed those stores, same-store sales figures would be a little bit more healthy than they are currently. So that's a problem. Another retailer that I could definitely see maybe filing bankruptcy despite having sold off a lot of their stores and unlocking a lot of value, by the way, is Rite Aid. Rite Aid is a prominent drugstore that competes with the likes of CVS and Walgreens. You see some problems, some chinks in their armor, and if you go around to local Rite Aid stores, the ones that are left that didn't either sell or close in the recent past, you're looking at stores that the inventory levels are a little low, the merchandising is a little thin, the stores are getting a little dirty. So while they're still in a lot of good locations, a lot of hard corners Rite Aid has, by the way, you see some problems with maybe lack of traffic and lack of prescriptions getting filled at their competing stores. Rite Aid then, therefore, has not a lot to offer in terms of the retail dynamic. So that is probably going to be a retailer to really keep an eye on over the next year. Lastly, Trent, I'll end off with these two. Pier 1, which is a retailer we've been talking about as of late. They were actually profitable not that long ago, and now they are dramatically unprofitable. They are losing money hand over fist. This is a retailer that really needs a massive turnaround despite all of the omni-channel initiatives that they put forth. All of the money that they spent hasn't really brought in the sales. It's brought in some traffic, but it hasn't brought in the sales that they were expecting. That is a problem for a retailer that has a lot of spend and a lot of debt now to have to deal with, and customers just really not buying a whole lot because they can go online. They can go onto Wayfair now and buy a lot of their product selection. Lastly, I'll end off with this for my looking ahead story. Mattress Firm, or Steinhoff International, which is the parent company that bought Mattress Firm just a few years ago. We covered that story on the podcast. Mattress Firm just filed bankruptcy not that long ago, so it's interesting. They have far fewer locations. Reason being is they wanted to get out of those expensive leases. So when Steinhoff actually purchased Mattress Firm, this is a massive company. There was a Mattress Firm on nearly every corner, it seemed. There was a lot of redundancy, a lot of stores cannibalizing other stores. And so you saw that as an obvious issue. And so with bankruptcy restructuring, you would think that closing the more expensive stores in terms of operating costs, they were expensive, was going to be a good thing for them. And everybody needs a mattress. And really, you think of online entrants coming in selling mattresses as more of a niche market, not really taking over the entire mattress market share. But the company is still reportedly having problems. And I find this very interesting because maybe it's Steinhoff. Maybe it's their management that has the problem, because at the end of the day, Mattress Firm was a profitable company and they did grow to a wide audience and had a very, very strong brand. They had brand equity. So when you think about continued problems through 2020, you should be questioning who is in charge of that operation now, especially now that you've consolidated stores, you supposedly streamlined supply chain. What exactly is going on? What is wrong with their company? And are they going to file bankruptcy? That's my looking ahead story, Trent, for this week.
And I think as far as Mattress Firm is concerned, what's really surprising for them is they do have a lot of partnerships with those bed-in-the-box type firms. So I agree with you. I think it might come down to management because they had a chance to restructure. And now the question is, did they do that properly? One other thing to keep in mind just regarding retail bankruptcies and bankruptcies of any kind, you see kind of two types of bankruptcies. One is like a slow bleed. Toys R Us would be a good example of a slow bleed there. Sears Holdings we thought was going bankrupt years before they actually did. And then there are some sudden bankruptcies that kind of come from nowhere. I look back to the 2014 bankruptcy of Alco stores. that kind of came out of nowhere. Now, it's not like the company was hugely profitable or anything, but ultimately in bankruptcy, they found assets to actually outweigh liabilities there, which is kind of unusual for a bankruptcy. So you see a few different types of bankruptcies, some that you knew were coming and some that you didn't. But ultimately, especially for publicly traded companies, usually you see a lot of working towards that bankruptcy. For Pier 1, I don't see them going bankrupt in the next 12 months just because they have so much in terms of the revolving credit facility. Same thing with JCPenney. They're nowhere near as bad off as what Sears Holdings was when they declared bankruptcy. So I think you've got a longer runway, Rite Aid too, before, if they do ever declare bankruptcy, before they do, I think you're looking at maybe 2 or 3 year time frames, and I'm not completely sold that any of those three companies would declare bankruptcy. I think what you see is a lot of smaller, maybe boutique clothing retailers. Again, you mentioned Christopher & Banks, you mentioned a maternity clothing retailer. Those are the retailers that are more susceptible to some of the bankruptcies that we've seen. And I think Ascene has kind of bought themselves a little bit of runway, what with their closure of the Dress Barn stores and exiting of that concept and the selling off of the Maurice's concept as well. That'll do it for us here on the Retail Focus podcast, a shorter podcast this week. One thing I do want to mention we're excited about, you might have noticed, hey, interviews kind of ground to a halt over the last year. I'm actually starting a new position with my employer. My previous position, the position I've had in the last year, didn't allow me to basically do these type of interviews, so we're looking forward to starting that up here in the next couple of weeks. Just something for you to look forward to. But in any case, for Leighton, I'm Trent, saying so long until next time.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.